Hello, and welcome to our series exploring the monumental shifts in the U.S. financial landscape over the last 10 years. Take a moment and think back to where you were a decade ago. Think about how you managed your money, how you paid your friends back for lunch, or how you thought about investing for the future. Chances are, the way you perform those tasks today looks dramatically different. The past decade, spanning roughly from the mid-2010s to the mid-2020s, has not just been a period of gradual evolution. It has been a decade of revolution. In this series, we will journey through the forces, technologies, and events that have reshaped the American world of finance. We'll explore how Wall Street, Main Street, and even the wallet in your pocket have been fundamentally altered. But before we dive into the specifics, it's crucial to establish the purpose and boundaries of our discussion. This series is created for informational and educational purposes only. The world of finance is complex and governed by strict regulations. The content we will cover is a historical and observational analysis of trends, events, and broad economic shifts. It is not, and should not be interpreted as financial, investment, legal, or tax advice. We will not be recommending any specific products, services, or investment strategies. Every individual's financial situation is unique, and decisions about your money should always be made in consultation with a qualified and licensed professional who understands your personal circumstances. Our goal here is to provide context and understanding, not direction. With that important understanding in place, let's set the stage for our journey. The decade we are examining did not begin in a vacuum. It began in the long shadow of the 2008 financial crisis. The aftershocks of that event were still shaping policy, consumer behavior, and institutional trust. The U.S. Federal Reserve had embarked on an unprecedented era of low interest rates, creating an economic environment that would fuel borrowing, investment, and a search for higher returns for years to come. This low-rate environment had two profound effects. First, it made traditional savings accounts less attractive, pushing people to look for other ways to grow their money. Second, the lingering distrust of large, established banks, which many blamed for the crisis, created a fertile ground for new players. A generation of consumers, particularly millennials who were entering their prime earning years, were skeptical of the old guard and digitally native. They were ready for something different. And that something different arrived with incredible speed, delivered through the glowing screen of the device in their hands. The smartphone. If one single force could be said to define the financial changes of the last decade, it is the rise of financial technology, or Fintech. The smartphone went from being a communication device to a full-fledged financial command center. Think about it. A decade ago, banking often meant a trip to a physical branch. Investing required a desktop computer and a relationship with a brokerage firm. Sending money to a friend might have involved writing a check or handling cash. Today, these activities are accomplished with a few taps on an app. Companies like Venmo, Cash App, and Zelle have made peer-to-peer payments instantaneous and social. Robo-advisors like Betterment and Wealthfront brought algorithm-based investment management, once reserved for the wealthy, to the masses with low fees and minimal starting capital. Perhaps most disruptively, commission-free trading platforms, spearheaded by Robinhood, completely upended the traditional brokerage model. They removed the cost barrier to buying and selling stocks, opening the floodgates for millions of new, younger investors to enter the market. This wasn't just a change in technology, it was a profound cultural shift. It led to the democratization of finance, a theme we will return to again and again. It meant that conversations about stocks and investing moved from exclusive country clubs and Wall Street trading floors to social media platforms like Reddit and Twitter. This wave of technological innovation created a new set of expectations for consumers. We now demand speed, convenience, and transparency from our financial services. We expect to open a bank account, apply for a loan, or buy a stock in minutes, not days. This pressure forced the titans of traditional finance, the giant banks and investment houses, to either adapt or risk becoming obsolete. They began pouring billions of dollars into their own digital transformations, acquiring fintech startups, and redesigning their customer experiences to compete in this new, fast-paced world. So, as we stand here today and look back, we see a landscape transformed. The gatekeepers of finance have seen their walls lowered. The barriers to entry for both consumers and new companies have fallen. And the very definition of what it means to bank, to pay, and to invest has been rewritten. In the chapters that follow, we will deconstruct this transformation piece by piece. We will take a deep dive into the fintech revolution itself, exploring how specific technologies changed our relationship with money. We'll examine the wild rise and turbulent journey of cryptocurrencies and digital assets. We'll analyze the immense economic impact of the COVID-19 pandemic and the government's unprecedented response. We will also explore the changing face of the American investor, the evolving role of the Federal Reserve in a modern economy, and the future of work, retirement, and personal finance in this new era. This first chapter is merely the prologue. We've sketched the outlines of a decade defined by the echoes of a past crisis and the dawn of a technological revolution. We've seen how a low-interest rate world and a new generation's expectations created the perfect storm for disruption. Now let's begin to fill in the details. Our journey starts with the engine of it all. In Chapter 2, we will explore the fintech revolution, from Wall Street to your pocket. Welcome back. In our last chapter, we set the stage, looking back at a decade that began in the shadow of a financial crisis and ended in a world transformed by technology. We identified financial technology, or fintech, as the primary catalyst for this change. Now, it's time to move beyond the abstract and look at the tangible tools and platforms that drove this revolution. We're going to explore how complex financial services were taken from the marble halls of Wall Street and placed directly into the palm of your hand. Once again, as we explore these specific companies and technologies, it's important to remember that this discussion is for educational and informational purposes only. We are analyzing their impact on the market and consumer behavior, not endorsing or recommending their use. All financial decisions should be made with the guidance of a qualified professional. The fintech revolution didn't happen all at once. It advanced on several fronts, but its first and most profound impact on daily life was in the realm of payments. For generations, paying someone back meant one of three things: cash, a check, or a slow, often cumbersome bank transfer. Fintech obliterated that reality. Peer-to-peer, or P2P, payment applications emerged as the vanguard of this new era. Platforms like Venmo, which was acquired by PayPal, and later, Block's Cash App, did more than just move money. They made financial transactions social and frictionless. The act of splitting a dinner bill, paying for a share of the rent, or buying something from a friend was reduced to a few taps on a smartphone. Venmo's social feed, where users could see public, emoji-filled descriptions of payments between friends, turned a mundane task into a connected experience. Meanwhile, Zelle, a service backed by the large traditional banks themselves, was a direct response, using existing banking infrastructure to offer instant transfers without a third-party app. This wasn't just about convenience. It was a fundamental rewiring of our social and financial interactions. The expectation of immediate, digital, and mobile-first payments became the new normal, setting the stage for deeper changes to come. With consumers now comfortable managing their money on their phones, the next frontier was investing. For most of history, the world of investing was intimidating and inaccessible to the average American. It often required large sums of money, a relationship with a human financial advisor, and the payment of significant fees and commissions. Fintech attacked these barriers with two distinct innovations. First came the rise of the robo-advisor. Companies like Betterment and Wealthfront pioneered a new model. Instead of speaking to a person, a user would answer an online questionnaire about their financial goals, age, and tolerance for risk. An algorithm would then construct and automatically manage a diversified portfolio of low-cost funds. This model introduced sophisticated strategies, like automatic portfolio rebalancing and tax loss harvesting, to a massive new audience at a fraction of the cost of traditional advising. It was a data-driven approach that appealed to a younger, tech-savvy generation. The second, and perhaps more explosive, innovation was the advent of commission-free trading. While discount brokerages had been lowering costs for years, platforms like Robinhood took the radical step of eliminating the trading commission entirely for stocks and exchange-traded funds. This single change removed a huge psychological and financial barrier. Suddenly, someone with just $50 or $100 could start buying shares of public companies without seeing their initial capital eroded by fees. The result was a tidal wave of new retail investors entering the market. This phenomenon was enabled by a business model known as payment for order flow, where brokers are compensated by market-making firms for directing trades to them. While a complex and debated topic, this mechanism was the engine that powered the commission-free movement, fundamentally altering the landscape of market participation. This rise of new payment and investment platforms was part of a broader trend observers have called the Great Unbundling of the bank. For decades, a large bank was a bundle of services. You went to one institution for your checking account, your savings, your mortgage, your auto loan, and your investments. Fintech startups did the opposite. They unbundled the bank, focusing on doing just one thing exceptionally well. One company would focus only on student loan refinancing. Another would focus only on international money transfers. A third would build the best possible app for P2P payments. This strategy allowed them to be nimble and create superior user experiences that legacy banks struggled to match. However, as the decade progressed, a new trend emerged: rebundling. Once a successful fintech app had captured a large user base with its core product, it began adding other financial services. A trading app might add a checking account-like feature. A payment app might start offering the ability to buy cryptocurrency or stocks. The goal was to become a financial super app, a single place where a user could manage their entire financial life. This entire ecosystem was powered by a less visible, but critically important, technological shift involving things like application programming interfaces, or APIs. These are essentially digital communication channels that allow different software programs to talk to each other. This led to a concept called banking as a service, where licensed banks would handle the regulated parts of banking in the background while allowing fintech companies to build their own user-friendly apps on top. The titans of traditional finance were not standing still. Faced with this existential threat, they mounted a massive response. They invested billions in their own mobile apps, streamlined their online experiences, and in many cases, simply acquired the fintech startups that threatened them. They formed consortiums to launch their own competitors, like Zelle, and began to integrate the very technologies their disruptors had pioneered. So the fintech revolution of the last decade was more than just a collection of new apps. It was a fundamental restructuring of how financial services are created, delivered, and consumed. It shifted the balance of power toward the consumer, creating an ecosystem defined by choice, low cost, and digital convenience. While this digital revolution was reshaping the world of traditional finance, a completely separate and far more radical financial universe was beginning to emerge from the fringes of the internet into the mainstream consciousness. It was a world built not on banks or brokers, but on a technology called blockchain. In Chapter 3, we will venture into this new and often controversial frontier: the rise of the digital asset, cryptocurrency, and the blockchain boom. Hello and welcome back. In our previous chapter, we explored how the fintech revolution redesigned the services of traditional finance, making them faster, cheaper, and more accessible. But while that was happening, a parallel financial universe was emerging. It wasn't interested in redesigning the old system. It was focused on building a new one from the ground up, based on a radical idea called decentralization. This is the world of digital assets, cryptocurrencies, and the technology that underpins it all: the blockchain. Before we enter this fascinating and often turbulent world, a special note is essential here. The digital asset market is known for extreme price volatility and is considered highly speculative. This chapter will explain the core concepts, describe historical events, and analyze the impact of this technology. It is for educational context only and is absolutely not financial or investment advice. The risks involved in this space are significant, and anyone considering participation should conduct extensive research and consult with a qualified professional. So, what is the blockchain? In the simplest terms, imagine a digital notebook that is copied and spread across thousands of computers around the world. Every time a new transaction happens, a new entry is made in the notebook. Because everyone has a copy, it's incredibly difficult for any single person to cheat or change an entry without everyone else noticing. This shared, secure, and transparent ledger is the essence of blockchain. Its key features are decentralization, meaning no single company or government controls it, and immutability, meaning its records are designed to be permanent. This technology was first introduced to the world through its most famous application, Bitcoin. Created in 2009 by an anonymous entity known as Satoshi Nakamoto, Bitcoin was proposed as a peer-to-peer electronic cash system. It was a way to send value over the internet without needing a bank or a payment processor. Over the last decade, the narrative around Bitcoin expanded. For many of its proponents, it came to be seen as a form of digital gold, a scarce, durable asset that exists outside the control of any central authority, potentially acting as a hedge against inflation or economic instability. While Bitcoin proved that decentralized digital money was possible, the next major evolution came with the launch of Ethereum in 2015. Ethereum took the core idea of the blockchain and added a powerful new feature: smart contracts. Think of a smart contract like a highly advanced vending machine. A normal vending machine is programmed with a simple rule. If you insert a certain amount of money and press a button, it will release a specific item. A smart contract does the same thing with digital assets and complex agreements. It's a piece of code that automatically executes the terms of a contract when certain conditions are met, all without needing a human intermediary. This innovation was a game changer. It transformed the blockchain from just a currency ledger into a global, programmable platform. The existence of these new technologies sparked a decade of incredible market cycles, characterized by explosive growth and dramatic downturns. We witnessed several major bull runs, most notably in 2017, and again in 2020 and 2021. During these periods, public interest soared. Valuations of digital assets reached astronomical levels, fueled by media attention and stories of incredible gains. These frenzies were inevitably followed by sharp corrections, often called crypto winters, where prices would fall dramatically and public interest would wane. This cycle of boom and bust became a defining feature of the emerging asset class. As the technology matured, developers began using smart contracts to build more sophisticated applications. This led to the emergence of decentralized finance, or DeFi. The goal of DeFi was ambitious: to recreate the entire traditional financial system, lending, borrowing, trading, and earning interest, but in an open-source, decentralized way, without banks or brokerage firms. It was a bold experiment in creating a new financial infrastructure. At the same time, another application of blockchain technology captured the public's imagination: non-fungible tokens, or NFTs. An NFT is essentially a unique digital certificate of ownership, recorded on a blockchain, that can be tied to a piece of digital art, a collectible, or even a physical item. In 2021, the NFT market exploded into a cultural phenomenon, with some digital artworks selling for millions of dollars. While highly controversial, the NFT boom demonstrated that blockchain technology could be used to create and verify scarcity and ownership for digital items, a concept that had previously seemed impossible. The reaction from the world of traditional finance to all of this was a slow, cautious, and then accelerating evolution. In the early part of the decade, it was largely dismissed. By the end, nearly every major financial institution was exploring it. Investment banks started creating research desks dedicated to digital assets. Some firms began offering their high-net-worth clients access to crypto-related investment products. All the while, U.S. regulators, from the Securities and Exchange Commission (SEC) to the Treasury Department, grappled with a monumental task: how to apply century-old financial laws to this new, borderless, and code-based technology. This created a persistent environment of regulatory uncertainty. In summary, the last decade was the period when digital assets and blockchain technology roared from the academic fringe into the global financial conversation. It introduced a new paradigm for value, ownership, and financial infrastructure. It was a decade of innovation, extreme volatility, and intense debate, a debate that is far from over. While this digital financial world was experiencing its own dramatic cycles, the physical world was about to face a once-in-a-century crisis that would stress every aspect of the U.S. economy. This event would test the resilience of both the old financial system and the nascent digital one. In Chapter 4, we will analyze the COVID-19 shockwave, economic responses, and their financial fallout. Hello and welcome back. In our last chapter, we delved into the digital world of cryptocurrency, a financial system built on code. Now we turn our attention to a global event that was inescapably physical and real. In early 2020, the world was hit by the COVID-19 pandemic, an unprecedented public health crisis that triggered an immediate and severe economic shockwave. This was the ultimate stress test for the entire U.S. financial system, forcing a response from the government and the Federal Reserve on a scale not seen in generations. As we discuss these large-scale government programs and their economic consequences, please remember that our purpose is strictly educational. We are providing a historical overview of the events and policies as they unfolded, without political commentary or financial advice. The situation was complex, and the long-term effects are still being understood. The initial economic impact of the pandemic was swift and brutal. To slow the spread of the virus, vast sections of the U.S. economy were placed on lockdown. Businesses closed, travel ground to a halt, and millions of Americans were told to stay home. The effect on the financial markets was one of sheer panic. In a matter of weeks during February and March of 2020, the stock market experienced one of the fastest and sharpest declines in its history. At the same time, weekly unemployment claims surged to levels that dwarfed any previous record. The financial plumbing of the economy was at risk of freezing solid. Faced with a potential collapse, U.S. policymakers deployed a massive two-pronged response, one involving fiscal policy from Congress and the Treasury, and the other involving monetary policy from the Federal Reserve. First, let's look at the fiscal response. Fiscal policy refers to how the government uses spending and taxation to influence the economy. The cornerstone of this effort was the Coronavirus Aid, Relief and Economic Security Act, or the CARES Act, a multi-trillion-dollar relief package passed with bipartisan support. This and subsequent legislation included several key programs. The most direct were the economic impact payments, commonly known as stimulus checks, which sent money directly to the bank accounts of millions of American households. The goal was to provide immediate relief for essential expenses and support consumer spending. For businesses, the signature program was the Paycheck Protection Program, or PPP. This initiative offered forgivable loans to small businesses on the condition that they kept their employees on the payroll. It was an attempt to preserve the connection between workers and their jobs, even if the business itself was temporarily closed. Finally, the government significantly expanded unemployment benefits, adding a federal supplement to state-level payments to create a stronger safety net for the historic number of people who had lost their jobs. While Congress was acting on the fiscal front, the U.S. Central Bank, the Federal Reserve, unleashed its own arsenal of monetary policy tools. The Fed has two primary goals: maintaining stable prices and maximum employment. In a crisis, its most important role is to ensure the stability of the financial system. The Fed took two extraordinary steps. First, it cut its benchmark interest rate, the federal funds rate, to near zero. This made borrowing money cheaper for everyone, from large corporations to homebuyers, in an effort to encourage economic activity. Second, the Fed launched a massive asset purchase program, also known as quantitative easing, or QE. In simple terms, this meant the Fed began buying enormous quantities of U.S. Treasury bonds and other securities. This action injected trillions of dollars of liquidity, or cash, into the financial system. The primary goal was to ensure that credit markets, the places where businesses and governments go to borrow money, did not freeze up. It was a decisive move to signal that the Fed would do whatever it took to prevent a full-scale financial meltdown. The combined effect of this monumental fiscal and monetary stimulus was profound and, in some ways, surprising. While the real economy on Main Street was still struggling, the financial markets staged a remarkable and incredibly rapid recovery. The stock market went from a historic crash to new all-time highs within the same year, creating a stark disconnect that puzzled many observers. The stimulus also had a dramatic impact on household finances. For those who were able to keep their jobs and work from home, spending on things like travel, dining, and commuting disappeared overnight. Combined with the stimulus payments, this led to a massive spike in the personal savings rate. Americans, in aggregate, had more cash on hand than ever before. This unique set of circumstances, more time at home, more cash for some, and the easy-to-use, commission-free trading apps we discussed in Chapter 2, created a perfect storm for a boom in retail investing. A new wave of individuals entered the stock market, using their savings and stimulus funds to trade. Beyond the immediate market effects, the pandemic acted as a powerful accelerator for trends that were already in motion. The shift to e-commerce, which had been steadily growing for years, became an explosion. The adoption of digital and contactless payments became a necessity. And most profoundly, the concept of remote work went from a niche perk to a mainstream reality for millions of white-collar workers, raising long-term questions about the future of cities and commercial real estate. In conclusion, the COVID-19 pandemic was a true black swan event that reshaped the decade. It prompted an economic intervention of historic proportions, which succeeded in stabilizing financial markets, but also left behind a legacy of significantly higher government debt, and set the stage for new economic challenges, including a fierce debate about inflation. This unique environment, combining accessible technology with unprecedented government stimulus, gave rise to a new and powerful force in the market, the individual investor. In Chapter 5, we will explore the new face of the American investor, from Reddit to Main Street. Hello and welcome back. In our journey so far, we've seen how technology made finance accessible, how cryptocurrency offered a new speculative frontier, and how a global pandemic created an unprecedented economic environment. These forces did not just change institutions, they changed people. They converged to create a new, powerful, and unpredictable force in the market: the individual retail investor. This chapter is their story. As we delve into the specific events and online communities that define this movement, it is crucial to reiterate our educational purpose. The strategies and stocks discussed were part of a highly speculative and volatile period. This content is a historical analysis of a cultural and financial phenomenon, not an endorsement of any particular investment strategy or a recommendation to buy or sell any security. For decades, the term retail investor simply meant an individual, non-professional person buying stocks. They were often seen as dumb money, a small and disorganized force in a market dominated by giant institutions. But in the last decade, and especially during the pandemic, that stereotype was shattered. The democratization of finance, which we touched on in Chapter 2, was now in full effect. Zero-commission trading apps were the tools, pandemic stimulus checks and increased savings were the fuel for some, and extended time at home was the opportunity. Millions of new participants flooded into the market. But what made this new wave of investors different was not just their numbers, but how they communicated. The financial conversations of this new generation did not happen on the golf course or through a wealth advisor. They happened online, in the new digital town squares of social media. And no platform was more central to this story than the Reddit forum called r/Wall Street Bets. It was a community with its own unique language, its own memes, and a shared culture that often blended sophisticated market analysis with irreverent humor and an extremely high appetite for risk. It was here that the stage was set for one of the most memorable financial dramas of the 21st century. The story centers on GameStop, a brick-and-mortar video game retailer whose business model was under pressure from digital downloads. By late 2020, many large, institutional hedge funds had decided GameStop was destined to fail. They were heavily shorting the stock. Let's briefly break down what that means. Short selling is a way to bet that a stock's price will go down. An investor borrows shares of a stock, sells them at the current price, and hopes to buy them back later at a lower price, returning the borrowed shares and pocketing the difference. However, if the stock price goes up, the potential losses for a short seller are in theory unlimited. Users on Wall Street Bets noticed that the amount of short interest in GameStop was extraordinarily high. More shares had been sold short than were actually available to trade. They saw this as an overreach by institutional investors and identified a vulnerability. If they could drive the price of the stock up, the short sellers would be forced to buy back shares to close their losing positions. This forced buying would, in turn, create more demand and push the stock price even higher. This phenomenon is called a short squeeze. In January of 2021, this theory was put into practice. A massive, decentralized wave of buying was unleashed by individual investors, organized and motivated through posts on Wall Street Bets. They bought shares. They bought risky call options. The result was an astonishing explosion in GameStop's stock price, which soared by thousands of % in a matter of days. A battle was openly being waged between a legion of individual investors and some of the most powerful hedge funds on Wall Street. The situation reached a fever pitch when several retail brokerage firms, most notably Robinhood, temporarily restricted the buying of GameStop and other so-called meme stocks. This action sparked a massive public outcry and accusations of market manipulation. The controversy grew so large that it led to hearings in the United States Congress, putting the CEOs of hedge funds and retail brokerages in the hot seat. Suddenly, the complex inner workings of the stock market were front-page news. Arcane topics like payment for order flow, the business model that allows for commission-free trades, but was now being scrutinized for potential conflicts of interest, were being debated by everyone. The GameStop saga pulled back the curtain on the market's plumbing and ignited a national conversation about fairness, access, and whether the system was truly set up for the benefit of all participants. While the financial gains for many were temporary, the lasting impact of this period was cultural. It reframed the act of investing for an entire generation. For some, it was no longer just a quiet, long-term activity for retirement. It could be a social, collaborative, and even defiant act. It proved that a large and coordinated group of individuals, armed with modern technology and a shared narrative, could challenge the giants of finance. It was a powerful demonstration that the retail investor was no longer a force to be ignored. In summary, the rise of the new American investor was not a single event, but the culmination of a decade of change. The tools of fintech, the isolation of a pandemic, and the connective power of social media all combined to create a new and dynamic force in the American financial landscape. This new domestic financial landscape, however, did not exist in a bubble. It was and is deeply connected to global economic forces and the policies of the most powerful financial institution in the country. In Chapter 6, we will zoom in on that institution to explore a decade of monetary metamorphosis, inflation, interest rates, and the Fed. Hello and welcome back. In our last chapter, we saw the rise of the individual investor, a powerful new force changing the dynamics of the stock market. But the market they operate in, and indeed the entire U.S. economy, is profoundly shaped by the decisions of one institution. The U.S. Federal Reserve, the Fed as it's known, is America's central bank, and its actions over the last decade tell a dramatic story of a complete policy reversal.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
From fighting off economic slumber to battling the highest inflation in 40 years. As we dissect the actions of the Federal Reserve, it's important to understand that monetary policy is a complex and often debated subject. Our goal here is to provide a clear, neutral, and historical overview of the Fed's policies and their effects on the economy. This is for educational context only, and should not be used to make financial decisions or anticipate future policy moves. To understand the dramatic shift, we have to first remember the economic environment of the years leading up to 2020. For most of the 2010s, the Fed's biggest problem was the opposite of what was to come. The primary concern was that inflation was too low and that economic growth was too slow. Following the 2008 financial crisis, the Fed kept its main policy tool, the federal funds rate, at or near zero for years. This was the era of easy money, designed to encourage borrowing, spending, and investment to stimulate a sluggish economy. The financial world grew accustomed to this low-rate, low-inflation reality. It became the new normal. Then, in the midst of the pandemic in August of 2020, the Fed announced a subtle but important change to its long-term strategy. It adopted a framework called flexible average inflation targeting. In simple terms, this meant that instead of trying to keep inflation at a strict 2% target, the Fed would now aim for inflation to average 2% over time. This new policy implied that the Fed would be willing to let inflation run above 2% for a while to make up for the many years it had run below that target. No one knew it at the time, but this new framework was about to be tested in the most extreme way possible. Starting in 2021, the U.S. economy began to experience a surge in inflation unlike anything seen since the early 1980s. This was not caused by a single factor, but by a perfect storm of economic forces. Global supply chains, snarled by pandemic lockdowns, couldn't produce and deliver goods fast enough. At the same time, consumer demand for those goods skyrocketed, fueled by government stimulus programs and a shift in spending away from services like travel and dining. A tight labor market put upward pressure on wages, and geopolitical events caused a spike in energy prices. Initially, the Federal Reserve and many other economists believed these price pressures would be transitory, a temporary side effect of the economy reopening. However, as prices continued to climb throughout 2021 and into 2022, it became clear that inflation was more persistent and widespread than anticipated. This realization forced the Fed to make a historic pivot. Beginning in March of 2022, the Federal Reserve abandoned its easy money stance and embarked on one of the most aggressive campaigns of monetary tightening in its history. Over the next year and a half, it raised the federal funds rate repeatedly and rapidly. The goal of these rate hikes was to cool down the economy by making it more expensive for businesses to borrow for expansion and for consumers to borrow for things like cars and homes. The Fed aimed to reduce overall demand, giving supply a chance to catch up and thereby bringing inflation back down toward its 2% target. The stated goal was to achieve a soft landing, taming inflation without causing a severe recession, a notoriously difficult maneuver to execute. The ripple effects of this rapid tightening were felt across every corner of the U.S. financial world. The once red-hot housing market cooled almost instantly as mortgage rates, which are heavily influenced by the Fed's policy, more than doubled. The technology sector and other high-growth stocks, whose valuations had been supported by a decade of low interest rates, experienced a significant downturn. The end of the easy money era also exposed vulnerabilities in the banking system. In the spring of 2023, several regional banks came under extreme stress. These institutions held large portfolios of long-term government bonds that they had purchased when interest rates were low. As the Fed raised rates, the market value of these bonds fell sharply, creating massive unrealized losses on their balance sheets, and leading to a crisis of confidence that resulted in bank failures and emergency interventions. It was a stark reminder that the transition away from a zero-interest rate world would not be without consequences. In summary, the last decade represents a complete metamorphosis in U.S. monetary policy. It began with the Fed trying to nudge inflation up, and ended with it using its most powerful tools to stamp it down. This dramatic pivot ended a long and transformative era of cheap money, fundamentally reshaping the financial landscape. and creating a new set of challenges and considerations for businesses, investors, and households. This new world of higher inflation and interest rates has profound implications for every American's long-term financial goals, particularly the cornerstone of financial security, retirement. In Chapter 7, we will explore the future of a graying nation. Retirement in a new financial reality. Hello and welcome back. In our last chapter, we examined the Federal Reserve's dramatic battle with inflation and the end of the easy money era. Those macroeconomic shifts don't just affect markets. They have a profound impact on one of the most personal and critical financial goals for every American, a secure retirement. This chapter explores the evolving landscape of retirement in the United States, a landscape being reshaped by demographics, economics, and a fundamental shift in responsibility. This discussion will cover trends, challenges, and legislative changes related to retirement. It is for educational and informational purposes only. We will not be providing any financial, investment, or retirement planning advice. Planning for retirement is a deeply personal journey that should always be undertaken with the guidance of a qualified financial professional. For much of the 20th century, the model for retirement was built on what was called the three-legged stool: Social Security, personal savings, and a company pension. Over the last few decades, and accelerating in the last one, that third leg has become increasingly wobbly. The single greatest change in the American retirement system has been the move away from defined benefit plans or pensions, where a company guaranteed you a certain income for life, to defined contribution plans, like the 401k. This represents a massive transfer of risk and responsibility. The burden of saving enough, investing wisely, and making that money last for an entire retirement now rests almost entirely on the individual's shoulders. This new reality of personal responsibility collided head-on with the new economic headwinds we discussed in our last chapter. The return of high inflation, for the first time in a generation, presented a severe challenge. For retirees living on a fixed income, inflation is a direct threat, as it erodes their purchasing power month after month. The money they carefully saved buys less at the grocery store and the gas pump. For those still saving, inflation means they have to accumulate an even larger nest egg to fund their future. At the same time, the Federal Reserve's response to inflation, rapidly raising interest rates, was a double-edged sword. On one hand, for those already in or near retirement with portfolios heavily weighted in bonds, the transition was painful. As interest rates rose, the value of their existing, lower-yielding bonds fell. Hello and welcome back. We've journeyed through the changing worlds of personal banking, investing, and retirement. But the other side of that coin is the American corporation itself, the companies we work for, buy from, and invest in. Over the last decade, these institutions have been at the center of a profound and often contentious debate about their very purpose. This chapter explores that evolution, a potential shift from a singular focus on profits to a broader sense of responsibility. This discussion will cover different philosophies of corporate governance and business trends. It is intended for educational purposes to provide context on a major business conversation. It is not investment advice and does not endorse any specific company, investment strategy, or political viewpoint. For nearly half a century, the dominant philosophy of American business could be summarized in two words: shareholder primacy. Championed by economist Milton Friedman in a famous 1970 essay, this doctrine states that the sole social responsibility of a business is to increase its profits for its shareholders, the owners of the company. This idea guided boardrooms, shaped executive compensation, and was the bedrock of business school education for generations. The goal was clear, measurable, and unambiguous: maximize shareholder value. But over the last decade, a competing idea, which had existed for years on the periphery, moved forcefully into the mainstream: stakeholder capitalism. This philosophy argues that a corporation's responsibilities extend beyond just its shareholders. It posits that for a company to thrive in the long term, it must create value for all of its stakeholders. This includes its employees who create the products, its customers who buy them, its suppliers, who are essential to its operations, and the communities where it operates. The argument is that neglecting these groups in the pursuit of short-term profit ultimately harms the company and its shareholders in the long run. This philosophical debate reached a symbolic tipping point in August of 2019. The Business Roundtable, an influential association composed of the CEOs of America's largest corporations, issued a stunning new statement on the purpose of a corporation. Signed by 181 top CEOs, the statement officially jettisoned their long-standing support for shareholder primacy. Instead, they pledged a commitment to all stakeholders. They committed to delivering value to customers, investing in employees through fair compensation and training, dealing fairly and ethically with suppliers, and supporting local communities. Generating long-term value for shareholders was listed last, as an outcome of successfully serving all other stakeholders. This was a landmark public declaration. While critics questioned whether it would lead to meaningful change, or was simply a public relations move, it undeniably signaled a major shift in the stated ideals of corporate America. This shift in philosophy was mirrored by a massive movement in the investment world. The rise of ESG, which stands for Environmental, Social, and Governance. ESG is a framework used by investors to evaluate a company's performance on a broad set of non-financial metrics. The environmental criteria look at a company's impact on the planet, such as its carbon emissions and sustainability practices. The social criteria examine how it manages relationships with its employees, customers, and society, looking at things like labor practices, data privacy, and diversity and inclusion efforts. And governance refers to how a company is led and managed, focusing on topics like executive compensation, transparency, and shareholder rights. Over the decade, trillions of dollars flowed into investment funds that used ESG criteria to guide their decisions. This wasn't just about ethics. The argument made by ESG proponents was that companies who scored well on these metrics were better managed, less risky, and therefore more likely to be profitable over the long term. This flood of capital sent a clear message to boardrooms. Investors were watching, and they cared about more than just the bottom line. However, this movement did not go unchallenged. A significant backlash emerged against both stakeholder capitalism and ESG. Critics argued that the concept of serving all stakeholders is vague and impractical. If a CEO is accountable to everyone, are they truly accountable to anyone? Others voiced concern that it gives corporate leaders too much discretion to pursue their own pet projects or political agendas, which may not align with the company's core business. This criticism became part of a broader cultural debate around what some have called woke capitalism. The argument from this perspective is that companies should focus on producing goods, providing services, and generating profits, rather than taking public stances on divisive social or political issues. This pushback has created a complex and often tense environment for corporate leaders, who now face pressure from all sides of the ideological spectrum. In conclusion, the last decade has been defined by a fundamental questioning of the purpose of the American corporation. The clear, simple doctrine of shareholder primacy has been seriously challenged by the broader, more complex philosophy of stakeholder capitalism, a movement given financial weight by the ESG investing boom. This debate is not settled. It continues to rage in boardrooms, in the media, and in the political arena. It represents one of the most significant and unresolved questions about the future of American finance and business. This debate over corporate purpose is happening at the same time a powerful new technology is reshaping every industry from the inside out. In Chapter 9, we will explore the age of AI and big data, reshaping industries and investment. Hello and welcome back. In our last chapter, we explored the philosophical debate over the purpose of a corporation. Now, we turn to a force that is less about philosophy and more about processing power, a technological revolution that is practically rewiring how those corporations operate and how the world of finance functions. This is the age of artificial intelligence and big data. This chapter will explain these technologies and their impact on the financial sector. Our discussion is for informational and educational purposes. We are not recommending any specific technologies or investment strategies that utilize them. The world of AI is complex and rapidly evolving, and its application in finance carries its own unique set of risks and considerations. First, let's demystify these terms. When we say big data, we're referring to the unimaginably vast and ever-growing ocean of digital information that is now generated every second. It comes from everywhere. Every credit card swipe, every online search, every social media post, and even from satellite imagery and sensor networks. The defining characteristics of big data are often called the 3 V's. The sheer volume of it, the high velocity at which it's created, and the wide variety of its forms. Artificial intelligence, or AI, is the engine that makes sense of all that data. In finance, when we talk about AI, we are typically talking about a subfield called machine learning. This is the ability for a computer system to learn from data, identify patterns, and make decisions or predictions without being explicitly programmed for every single task. It's a way of teaching computers to teach themselves. On Wall Street, these technologies have become the new frontier for gaining a competitive edge. An entire class of investment firms, known as quantitative or quant funds, use AI as their core operating system. Their algorithms sift through mountains of data at speeds no human team ever could, looking for subtle patterns and correlations to guide their trading strategies. And the data they use has expanded far beyond traditional financial reports. This is the world of alternative data. For example, an AI model might analyze satellite images of a retailer's parking lots across the country to predict its quarterly sales before the company ever releases them. It might parse the sentiment of millions of tweets about a new product to gauge public opinion in real time. Or it could track the global movements of shipping freighters to predict supply chain bottlenecks. This is a level of analysis that was pure science fiction just a decade ago. AI also powers the world of high-frequency trading, where algorithms execute millions of trades in fractions of a second to capitalize on tiny price discrepancies. This form of trading now accounts for a significant portion of all activity in the US stock market. But the impact of AI isn't confined to Wall Street. It has fundamentally changed the consumer finance experience as well. One of the most common and beneficial applications is fraud detection. AI systems learn your personal spending patterns, and when a transaction occurs that deviates from that pattern, like a purchase in a different country, it can be instantly flagged or blocked, protecting you from theft. AI is also transforming how credit decisions are made. Lenders are now using machine learning models that can analyze thousands of data points, far beyond a traditional credit score, to create a more nuanced picture of an applicant's creditworthiness. On your banking app, AI works in the background to analyze your spending habits and offer personalized insights or budget suggestions. And the robo-advisors we discussed earlier are a direct, consumer-facing application of AI, using algorithms to build and manage investment portfolios automatically. More recently, the early 2020s saw the explosion of generative AI, with large language models like ChatGPT capturing the world's attention. The financial industry was a fast adopter. These tools are now being used to instantly summarize long, dense financial reports, to act as a research assistant for human analysts, and to power increasingly sophisticated and helpful customer service chatbots. However, this powerful new age of AI is not without its challenges and significant ethical questions. One of the biggest concerns is algorithmic bias. If an AI is trained on historical data that contains human biases, for example, biased lending data from past decades, the AI can learn and even amplify that discrimination, leading to unfair outcomes in loan or job applications. There is also the black box problem. Some of the most advanced AI models are so complex that even their creators cannot fully explain how they arrived at a particular decision. This lack of transparency poses a huge challenge for regulation and accountability when an algorithm makes a mistake. And of course, the use of these technologies requires the collection and analysis of vast amounts of personal data, raising ongoing questions about privacy and security. In conclusion, AI and big data have officially moved from the pages of science fiction to the heart of the modern financial system. Over the last decade, they have become an invisible but powerful force that has rewired everything from high-speed trading to fraud protection. They have brought incredible new capabilities and efficiencies, but also a new class of complex risks and ethical dilemmas that we are only just beginning to navigate. This technological revolution has influenced every asset class, but perhaps none is more central to the American dream and household wealth than real estate. In Chapter 10, we will analyze the American Dream Reimagined, a decade of turbulence in the U.S. housing market. Hello and welcome back. After exploring the intangible world of AI and data, we now turn our focus to the most tangible and significant asset for most American families, the home. For generations, homeownership has been seen as the cornerstone of the American dream and the primary vehicle for building household wealth. But the last decade subjected this dream to a period of unprecedented turbulence, completely reshaping the U.S. housing market and our relationship with where we live. This chapter will provide a historical overview of the major trends in the U.S. housing market over the past 10 years. This is an analysis of economic events and market dynamics for educational purposes only. It is not real estate advice, and it is not a guide for when or where to buy or sell a property. To understand the chaos of the 2020s, we first have to remember the relative calm that preceded it. The period from the mid-2010s until early 2020 was one of slow and steady recovery. The trauma of the 2008 housing crash was fading, and the market was healing. Home prices were appreciating at a healthy, single-digit pace in most of the country, and mortgage rates were low and stable. It was a market that, for the most part, felt predictable. That predictability was about to be completely shattered. The catalyst, as with so many other things, was the COVID-19 pandemic. The ensuing lockdowns and the mass shift to remote work fundamentally changed what people wanted and needed from a home. Suddenly, the value of a small apartment in a dense city plummeted, while the demand for homes with an extra bedroom for an office, a backyard for the kids, and more overall space skyrocketed. This sparked what has been called the Great Reshuffling, a massive migration of Americans, often away from expensive coastal cities and towards more affordable suburbs, exurbs, and Sunbelt states. Pouring rocket fuel on this fire were the actions of the Federal Reserve. To support the economy, the Fed's policies pushed mortgage rates to their lowest levels in history. In 2020 and 2021, it was possible for qualified buyers to get a 30-year fixed-rate mortgage for under 3%. This dramatically increased the purchasing power of millions of Americans and unleashed a tidal wave of demand onto a market that was not prepared for it. What followed in 2021 and early 2022 was a housing market frenzy unlike any other. It was a period of intense bidding wars, with homes regularly selling for tens or even hundreds of thousands of dollars above the asking price. Buyers felt forced to take desperate measures, like waiving critical contingencies such as home inspections and appraisals. All the while, the number of homes available for sale, the inventory, dwindled to historic lows. This combination of insatiable demand and scarce supply created the most severe housing affordability crisis in at least a generation, as home prices shot up by 20 to 40% in many areas, completely decoupling from local wage growth. Then, just as quickly as the fire ignited, the Federal Reserve threw a bucket of ice water on it. As we discussed in Chapter 6, the Fed began aggressively hiking interest rates in 2022 to combat inflation. This caused mortgage rates to spike, doubling from under 3% to over 6% in a matter of months. This rate shock was the single biggest blow to housing affordability imaginable. A monthly mortgage payment for the same priced house was suddenly hundreds or even thousands of dollars more expensive. The market slammed on the brakes. Buyer demand evaporated, and the number of home sales plummeted. However, prices did not crash in the way many expected. This is due to a powerful new dynamic governing the market, something economists call the lock-in effect. Millions of current homeowners are now sitting on mortgages with golden handcuffs. They have a 3% interest rate in a 6 or 7% world. They are financially locked in. If they were to sell their home, they would have to buy a new one at a much higher interest rate, potentially doubling their monthly payment for a similar house. As a result, very few people are willing to move, which is keeping the supply of existing homes for sale at historic lows. This strange dynamic of low demand and low supply has kept prices stubbornly high. This decade also saw the rise of property technology, or PropTech. Companies known as iBuyers promised a new, streamlined way to sell your home with an instant cash offer. And the entire process of searching for a home, applying for a mortgage, and closing the deal moved increasingly online. At the same time, the role of large-scale institutional investors buying up single-family homes to convert into rentals became a growing and often controversial topic of conversation. In conclusion, the American housing market experienced a decade of whiplash. It went from a steady recovery to a pandemic-fueled mania, followed by a sudden policy-induced deep freeze. The very idea of what a home is for was reimagined, and the market is now stuck in a new and difficult reality, defined by the lock-in effect and a persistent, painful affordability crisis for a new generation of buyers. This entire financial ecosystem, from buying a home to starting a business, is built on a foundation of credit and debt. In Chapter 11, we will delve into the American debt story, a decade of evolving credit and consumer borrowing. Hello and welcome back. In our last chapter, we explored the turbulent U.S. housing market, an asset that is central to American life. But for most people, the path to owning that asset, and participating in the modern economy at all, is built on a foundation of credit and debt. This chapter delves into the American debt story of the last decade, a period of steady growth, a pandemic paradox, and the rise of new ways to borrow. This is an educational overview of economic trends in consumer borrowing. We will be discussing various types of debt, including credit cards and student loans. This is not financial advice. Decisions about taking on, managing, or paying off debt are deeply personal and should be made in consultation with a qualified financial or credit counseling professional. The story of the last decade begins with a rising tide. Following a brief period of paying down debt, or deleveraging, after the 2008 financial crisis, U.S. household debt began a steady and relentless climb. Throughout the mid to late 2010s, total household debt balances grew year after year, eventually surpassing their prior peaks. This growth was fueled by the low interest rate environment we've discussed, making it cheaper to finance homes, cars, and education. While mortgages made up the largest piece of the pie, two other categories were central to the story: auto loans and, most notably, student loans. Then, the COVID-19 pandemic introduced a strange and unexpected paradox in American borrowing habits. As the government rolled out massive stimulus programs and lockdowns curtailed spending on travel, dining, and entertainment, many American households found themselves with a surplus of cash. A significant portion of this money was used to pay down high-interest debt. For the first time in years, the nation's total credit card balance fell dramatically. It was a rare moment of deleveraging for the American consumer, a temporary reprieve from the ever-growing mountain of debt. However, one category of debt was largely immune to this trend, and has become perhaps the defining financial challenge for a generation: student loans. Over the course of the decade, the total student loan balance in the United States swelled to over $1.6 trillion, surpassing both total auto loan and credit card debt. In response to the pandemic, the federal government took an unprecedented step. It paused all payments and froze interest accrual on the vast majority of federal student loans. This pause, which was extended multiple times, lasted for more than 3 years. It provided significant financial relief to tens of millions of borrowers, but also fueled an intense national debate about the cost of higher education and the potential for widespread loan forgiveness, a debate that continues to this day. While the student loan saga unfolded, a new and disruptive force was emerging in the world of credit, powered by Fintech. This was the explosive rise of buy now, pay later, or BNPL services. Companies like Affirm, Klarna, and Afterpay partnered with thousands of online retailers to offer a new, seamless way to finance purchases. Instead of putting a charge on a traditional credit card, BNPL allows a consumer to split the cost of an item into a handful of equal, and often interest-free, installment payments. This model, essentially a high-tech reinvention of the old department store layaway plan, proved incredibly popular, especially with younger consumers, and became a ubiquitous feature of the e-commerce landscape. But the temporary reprieve in credit card debt was not to last. As the economy reopened and inflation began to surge in 2021 and 2022, the trend sharply reversed. With the cost of everyday necessities like gasoline and groceries rising rapidly, many American families turned back to their credit cards to bridge the gap in their budgets. As a result, total U.S. credit card debt surged past its pre-pandemic levels, reaching new all-time highs. This time, however, the debt came with a much higher price tag. As the Federal Reserve aggressively raised interest rates to fight inflation, the annual percentage rates, or APRs, on credit card debt soared to their highest levels in decades. This created a difficult situation for many households. They were becoming more reliant on credit at the exact moment that credit was becoming more expensive. In summary, the story of American debt in the last decade was a complex journey. It began with steady low-cost growth, was briefly and bizarrely interrupted by a pandemic-induced paydown, and was dominated by the persistent and unresolved issue of student loans. The decade saw the rise of new fintech borrowing tools, and ended with a painful surge in high-cost credit card debt, as American households grappled with the financial hangover of inflation. All of these transactions, from paying a mortgage to swiping a credit card, rely on a vast and rapidly evolving infrastructure. In Chapter 12, we will explore the future of money, the digital dollar, stablecoins, and the payments revolution. Hello and welcome back. In our last chapter, we explored the evolving story of American debt. But underlying every loan, every purchase, and every payment is the system that allows money to move. For decades, that system worked quietly in the background. But over the last 10 years, driven by new technology and a demand for speed, a profound conversation has begun about the very nature of money itself. This chapter explores that revolution, from private sector innovations to the debate over a potential U.S. digital dollar. This discussion will cover emerging financial technologies and theoretical concepts like central bank digital currencies. It is for educational purposes only. The information provided is not an endorsement of any digital asset or a prediction of future government policy. These are complex topics with ongoing debates about their potential risks and benefits. For most of the last few decades, the plumbing of the U.S. payment system was reliable but slow. A typical bank transfer, using the automated clearinghouse or ACH system, could take 1 to 3 business days to settle. In an increasingly 24/7 digital world, where information moves instantly, this lag in the movement of value became more and more noticeable. This created an opening for innovation from both the private and public sectors. The first major disruption came from the world of cryptocurrency, with the rise of stablecoins. In simple terms, a stablecoin is a type of digital token that lives on a blockchain.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided,
But is designed to maintain a stable value by being pegged to a real-world asset, usually the US dollar. For every one stablecoin token issued, the private company behind it is supposed to hold $1 worth of highly liquid assets, like cash or short-term government bonds, in reserve. Their primary purpose was to act as a stable bridge in the volatile crypto markets, allowing traders to move in and out of positions quickly, 24/7, without having to wait for the traditional banking system. However, stablecoins have not been without controversy. Questions have been raised about the quality and transparency of the reserves backing some of the largest stablecoins. The risks were put on stark display in 2022 with the collapse of an algorithmic stablecoin called Terra USD, which was not backed by real-world assets but by a complex, automated balancing act with another cryptocurrency. Its failure highlighted the critical difference between fully reserved stablecoins and more experimental models, and it drew intense scrutiny from regulators. While the private sector was experimenting, the official sector was working on an upgrade to the existing system. In July of 2023, the Federal Reserve launched the FedNow service. FedNow is not a new currency but a new payment rail. It's an instant payment infrastructure that allows participating banks and credit unions across the country to send and receive money on behalf of their customers in a matter of seconds. And it operates around the clock, 365 days a year. FedNow represents an evolutionary step, a significant modernization of the existing banking system to meet the demand for real-time payments. But beyond this upgrade lies a much more revolutionary and controversial question. Should the US create its own official digital currency? This is the debate around a central bank digital currency, or CBDC, often referred to as a digital dollar. A digital dollar would be fundamentally different from the money in your bank account today. It would be a direct liability of the Federal Reserve, just like a physical dollar bill is. It would not be a cryptocurrency and would not require a commercial bank account to hold. Proponents of a CBDC argue that it could have several benefits. It could make our payment system even more efficient and less costly. It could potentially improve financial inclusion by giving people who don't have access to traditional banking a way to receive and make digital payments. And some argue that in a world where other countries or blocs are developing their own CBDCs, the US needs one to maintain the international prominence of the dollar. However, the concerns surrounding a potential digital dollar are significant, which is why US policymakers are proceeding with extreme caution. The primary concern is privacy. A CBDC could, in theory, allow the government to have a record of every single transaction made by every citizen, raising fears of surveillance. Another major concern is the potential disruption to our current banking system. If people could hold their money in perfectly safe digital dollars directly with the Fed, they might pull their deposits out of commercial banks, which could destabilize those banks and reduce their ability to lend. Finally, the cybersecurity challenges of creating and protecting a system of this scale and importance would be immense. Given these profound questions, the Federal Reserve's official position has been one of research and study, not action. The Fed has stated that it has not decided to move forward, and would not do so without clear support and authorizing legislation from Congress and the executive branch. In conclusion, the last decade has opened a new chapter in the history of money. The demand for faster payments has been met by private sector innovations like stablecoins and public sector upgrades like FedNow. Looming over it all is the deep, complex, and unresolved debate about whether the dollar bill itself will one day have a purely digital twin. This increasingly digital and complex financial world presents a new landscape of risks for individuals and businesses. In Chapter 13, we will examine a new world of risk, how the insurance industry is adapting to a decade of change. Hello and welcome back. In our last chapter, we discussed the future of money and the systems that move it. But underlying the entire financial world is the concept of risk, the uncertainty of the future. The sector designed to be society's shock absorber, to price that risk and provide a safety net, is the insurance industry. For decades, it was a slow-moving, predictable business. But the last 10 years have forced it to confront a new and daunting landscape of risk, from a changing climate to a weaponized digital world. This chapter will provide a high-level overview of the major challenges and adaptations in the U.S. insurance industry. This analysis is for educational purposes only. It is not advice on what insurance products to buy or which companies to choose, as individual needs vary greatly and should be discussed with a licensed insurance professional. The most profound and tangible challenge for the insurance industry this past decade has come from the planet itself. The increasing frequency and severity of natural disasters have fundamentally altered the business of property and casualty insurance. The industry is built on historical data and predictive models, but in recent years, those models have been breaking down. We've seen this with the devastating wildfire seasons in California, Colorado, and other western states, which have caused tens of billions of dollars in losses. We've seen it with the growing intensity of hurricanes along the Atlantic and Gulf coasts, and with severe flooding and convective storms in the Midwest. The consequences for consumers and insurers have been severe. In high-risk areas, homeowners have been hit with staggering premium increases, and in some cases have been unable to find coverage at all as private insurers, facing unsustainable losses, have decided to exit those markets entirely. This has led to a growing reliance on state-run insurers of last resort, straining public resources and highlighting the immense challenge of pricing risk in the face of a changing climate. While insurers were grappling with these physical threats, a new, intangible, and man-made threat was exploding: cyber risk. A decade ago, cyber insurance was a niche product. Today, it is a business necessity. The rise of sophisticated ransomware attacks, where criminals digitally kidnap a company's data and demand a ransom for its return, and massive data breaches have created a multi-billion-dollar insurance market from scratch. This has been incredibly challenging for insurers. Unlike hurricanes or fires, which they have a century of data on, cyber attacks have a very short and constantly evolving history. Pricing the risk of a new, unknown computer virus or a state-sponsored hacking campaign is incredibly difficult. Furthermore, cyber risk is systemic. A single successful attack on a major cloud provider could simultaneously impact thousands of companies that are all insured by the same carrier, creating the potential for a catastrophic, cascading loss event. The COVID-19 pandemic also served as a massive, global stress test for the industry. The most contentious issue was business interruption insurance. Thousands of businesses, forced to close by government lockdowns, filed claims, arguing that the pandemic was interrupting their operations. Insurers, however, generally argued that these policies were designed to cover losses from direct physical damage, like a fire, not from a virus. This led to a wave of litigation that is still being sorted out. The pandemic also had a direct impact on life and health insurers, who faced a surge in claims and were forced to completely reevaluate how they model the risk of a global health crisis. Faced with this new world of risk, the traditionally conservative insurance industry had no choice but to innovate. This movement has been called insurtech. The core of this revolution is data. Insurers are now using artificial intelligence and massive new datasets to underwrite and price risk with a level of precision that was previously impossible. For example, instead of just using a zip code to determine wildfire risk, an AI model can now analyze satellite imagery of a specific property, assessing its roof material, the slope of the land, and the density of the surrounding vegetation. Perhaps the most visible example of this for consumers is in auto insurance, with the rise of telematics. Many insurers now offer usage-based insurance programs where a driver can volunteer to use a smartphone app or a small device in their car to share data about their actual driving habits. Things like how fast they drive, how often they brake hard, and the time of day they're on the road. In return, safe drivers can receive significant discounts on their premiums. Finally, the consumer experience itself has been transformed, driven by the seamless digital experiences offered by banks and fintech companies. Insurers have had to move away from slow, paper-based processes. Today, you are far more likely to buy a policy, manage your account, and even file a claim entirely through a mobile app. In conclusion, the insurance industry spent the last decade on the front lines, confronting society's most complex and emerging challenges. It has been a painful but necessary transformation, forcing the industry to adopt technology and data not just as a matter of convenience, but as a matter of survival in a world where risk itself has been redefined. All of these changes, from fintech and crypto to new corporate philosophies, have presented a profound challenge for the rulemakers. In Chapter 14, we will explore the regulatory maze, Washington's scramble to keep pace with a changing financial world. Hello and welcome back. In our last chapter, we explored how the insurance industry is grappling with a new generation of risks. This raises a critical question. Who is responsible for managing risk for the entire financial system? That task falls to a collection of government agencies and lawmakers in Washington, D.C. But over the last decade, they have faced an unprecedented challenge. Trying to apply a 20th century rulebook to a 21st century financial world that is changing at warp speed. This chapter will provide an educational overview of the major regulatory challenges and debates of the last 10 years. Our purpose is to explain these complex issues neutrally. This is not legal advice or a political commentary on any specific regulation or agency. The regulatory landscape is in a constant state of flux, and the issues are highly complex. The fundamental challenge for U.S. financial regulators this past decade can be boiled down to a single problem. The laws they enforce were written for a different world. The foundational pillars of American financial regulation, like the Securities Act and the Banking Act, were passed in the 1930s. They were designed for a world of paper stock certificates, physical bank branches, and human stockbrokers. Regulators have spent the last 10 years in a constant scramble, trying to stretch these old definitions to cover radically new innovations, and the fit is often awkward, if not impossible. Nowhere has this challenge been more apparent than in the world of cryptocurrency. The single biggest regulatory question of the decade for this new asset class has been a simple one. What is it? Is a crypto token a security, like a stock, which would put it under the jurisdiction of the Securities and Exchange Commission, or SEC? Is it a commodity, like gold or oil, which would put it in the camp of the Commodity Futures Trading Commission, or CFTC? Or is it something else entirely? This uncertainty has led to a jurisdictional tug-of-war between the agencies, and has created what many in the industry call regulation by enforcement. Instead of issuing clear new rules for the road, regulatory clarity has often come in the form of high-profile lawsuits against crypto companies. This approach has left much of the industry in a state of legal limbo, arguing that they are being forced to navigate a maze without a map. Regulators have also been playing catch-up with the rapid evolution of consumer-facing fintech. The rise of buy now, pay later services, for example, attracted the attention of the Consumer Financial Protection Bureau, or CFPB. The agency has raised questions about whether these services are, in effect, a new form of credit that operates outside of the traditional consumer protection and disclosure laws that apply to credit cards. Similarly, regulators have been taking a closer look at so-called neobanks and payment apps to ensure that consumers clearly understand the difference between a tech company that offers bank-like services and a chartered bank that offers government-backed deposit insurance. The meme stock phenomenon of 2021 also served as a major wake-up call for regulators, forcing them to look under the hood of our modern market structure. The event sparked intense scrutiny from the SEC and Congress into a range of issues. These included the business practice of payment for order flow, the potential conflicts of interest for commission-free brokers, and the psychological effects of gamification, features on trading apps that might encourage risky behavior. Finally, the debate over corporate purpose that we discussed in Chapter 8 also found its way into the regulatory arena. The most significant move in this area came from the SEC, which proposed a sweeping new rule that would require public companies to disclose their climate-related risks and, in some cases, their greenhouse gas emissions. Proponents argued this was a necessary step to provide investors with standardized, consistent information on a critical financial risk. Opponents, however, contended that it represented a significant overreach of the SEC's authority, pushing it into the realm of environmental policy. This debate over what constitutes financially material information for investors is a central regulatory battle of our time. In summary, the story of financial regulation in the last decade has been a story of a system under stress. Washington's regulators have been in a constant state of reaction, trying to address the risks and opportunities of a financial world being reinvented by technology and new market dynamics. The result has been a complex, often confusing, and highly uncertain regulatory maze, with many of the most important rules for the future of finance still waiting to be written. We've journeyed through a decade of profound transformation, from technology and investing to the very nature of money. In our final chapter, we will bring these threads together to look at the big picture. In Chapter 15, we will explore a new financial order, key themes, and the road ahead. Hello, and welcome back for the final chapter of our series. Over the last 14 chapters, we have journeyed through a decade of truly profound transformation in the American financial world. We've dissected the technologies, analyzed the market shocks, and explored the evolving behaviors and philosophies that have defined our time. In this concluding chapter, we will step back from the individual details to connect the dots, identify the major themes that have emerged, and look at the key questions that will shape the road ahead. As we conclude, please remember that this series has been for educational and informational purposes only. This final chapter will synthesize the trends we've discussed and will pose questions about the future, but it will not offer predictions or financial advice. In a world of change, the most powerful tool is a clear understanding of the forces at play. Looking back, the first and most visible theme of the last decade was the democratization of access. For generations, the world of sophisticated finance was an exclusive club, protected by high fees, complex products, and informational gatekeepers. Technology, as we saw with the Fintech revolution, shattered those walls. Commission-free trading, user-friendly mobile apps, and robo-advisors put the tools of Wall Street into the pockets of Main Street. The rise of social media as a forum for financial discussion, exemplified by the meme stock phenomenon, showed that a new, decentralized, and powerful class of retail investors had arrived. Finance was no longer a conversation happening behind closed doors. It was happening in public for everyone to see. The second major theme, and the engine behind almost every other change, was technology as the great accelerator. Technology wasn't just a single story, it was the undercurrent in every story. The blockchain and cryptocurrencies introduced a radical new, decentralized vision for finance. Artificial intelligence and big data became the new brains of Wall Street, driving everything from high-frequency trading to the insurance industry's new models for pricing risk. And the smartphone became the universal remote control for our financial lives. This technological surge didn't just create new products. It accelerated the pace of change itself, forcing every institution, from the oldest banks to the federal regulators, into a constant race to adapt. The third, and perhaps most profound, theme was the end of a 40-year economic supercycle. From the early 1980s until the pandemic, the American economy was largely defined by a single, powerful trend: a long, steady decline in interest rates and inflation. This multi-decade era of easy money shaped every financial decision, fueled bull markets in stocks and real estate, and became the foundational assumption for an entire generation. The events of the early 2020s, the pandemic shock, the unprecedented government response, the subsequent surge of inflation, and the Federal Reserve's aggressive pivot to high interest rates, brought that era to a definitive and jarring end. We have now entered a new and much more uncertain economic reality, and its full consequences are still unfolding. Finally, a more subtle but equally important theme has been the individualization of financial risk. Over the last decade, we have seen a quiet but steady transfer of responsibility from large institutions onto the shoulders of the individual. The continued decline of corporate pensions has meant that the risk of saving and investing enough for a 30-year retirement now belongs almost entirely to the worker. The rise of the gig economy has left millions without the traditional financial safety nets of an employer. The new, empowered retail investor is also a newly exposed investor, responsible for navigating increasingly complex and volatile markets on their own. So what does the road ahead look like? Instead of making predictions, we can define the future by the great unanswered questions that have emerged from this decade of change. First, how will our 20th century regulatory system adapt to 21st century technology? Can lawmakers and agencies create a clear set of rules for digital assets and AI in finance? Or will they be stuck in a perpetual game of catch-up? Second, what will be the lasting legacy of decentralized technologies? Will blockchain and stablecoins become an integrated part of our financial plumbing? Or will they remain on the periphery? Third, how will an entire economy, from consumers with credit card debt to the US government itself, learn to operate in a world that is no longer defined by near-zero interest rates? And finally, can the tension between a corporation's responsibility to its shareholders and its obligations to its employees, customers, and communities be resolved in a sustainable way? The answers to these questions will define the next decade of American finance. The world we've explored in this series, a world of instant payments, digital assets, AI-driven markets, and empowered individuals, is the new reality. The foundational assumptions that govern the financial world for generations have been broken. Understanding this new, complex, and dynamic order is the essential first step to navigating it. Thank you for joining us on this journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.